Morning. It's Wednesdays. I'm Wayne. Welcome to Wednesdays with Wayne. In case you're wondering if your camera is crooked, no. Mine's a little off, and I'll explain why in a few minutes. Before we get started today, the first thing I want to do is, once again, is thank you for your time. I also want to thank, I've said it before and I'll say it again, one of the most valuable things anyone can give you is their time. So I thank you for your time, and I'm going to do my best to make sure your time is well spent. So thank you for showing up. I also want to thank Mark Zuckerberg and the folks at Facebook for allowing us to do this. I still think it's incredible that we can do this free of charge. I mean, to us to be able to pass on our information to those of you out there that want it and know money's being exchanged is very cool. So thank you to them. Also want to thank our staff, our management team, our employees, and our education counselors who help make all this possible, creating the content, proofing the content, curating the content, preparing the content, and getting it all ready to be and producing it. So thank you to all of them. I also want to thank my wife and business partner and best friend I ever had, Lynn, for helping us do this. And she and I have been partners for 35 years. We've owned the school, real estate school, for 30 years. So the other sponsor is the Real Estate Business School, where you get your license and learn to use it. Your license guarantees you nothing, and those of you that are licensed know that, and those of you that are about to get licensed need to know that, because where you go to school, who teaches you, and what you learn does make a difference in how successful you will be. Your license guarantees you nothing. So what we're talking about, what we've been talking about, is the three types of education that we need to be successful in today's environment. One is a technical education. The technical education alone will not get you anywhere. When I say technical, I'm talking about if you were deciding to get a real estate license, you need a technical education. You'll learn a new language, some math formulas, and contracts. This is technical information. Most of the lawsuits and complaints to the Real Estate Commission come from contract disputes because agents don't have the technical education they need to fill out the forms. So it's crucial, but it's not enough. You also need a business education. That's the second type of education. What I mean by that is I've been on hundreds of listing presentations. No, your camera isn't crooked. It's set up that way on purpose. I'll explain in a minute. I've been in hundreds of real estate transactions, over 800, thousands of business transactions. And of all these listing presentations I've been on, I've made my presentation to the seller. Here's the range of value. Here's how we'll market it. Here are the two markets. Here's how we do it. And at the end, no one's ever said to me, you know, Wayne, that was pretty good, but let me ask you a question. What is the difference between accretion and erosion? How many cubic yards of concrete are in my driveway? So they don't care. They don't even know to ask those questions. That's just something to state. I want you to memorize to test your intelligence. Well, what we know is talking isn't teaching. What we know is talking isn't teaching, listening isn't learning, and the memorization of right answers is no indication of a person's intelligence or ability. Whoever's doing the talking is doing the learning. Whoever's making the most mistakes is doing the learning. But the school system punishes us for making mistakes. So I'm going to ask you to go out and mess up as much stuff as possible and correct them quickly. Because we're humans and we're designed to learn via trial and error. So if you're not making enough mistakes, you're not learning enough. So get out there and screw some stuff up. But correct your mistakes, as I said before. What is the biggest obstacle to learning? Ego. So get the ego out of the way, get on with making those mistakes, and go figure it out. So that's the second type of education, business. We teach business education with this diagram right here. It's called the Real Estate Business School. And it shows the 6 components of the business and the definition and goal of each. And all our courses are designed to teach you how to make the transition, the mental transition, to let go of everything the school system taught you, which is how to be a good employee, to go and be a good employer, to be able to do a good business. It's a transition from employee to sole proprietor to business owner. And then we teach the third type of education, which is crucial, financial education. You've got to know your numbers. So what we've been talking about is how to invest in real estate. What are the basic fundamentals? And for those of you seasoned investors out there, today you're going to find rather elementary and basic, but I want to talk to The people who haven't had the opportunity to start investing yet, or maybe have begun but not quite clear on the subject. There are two things we're going to finish covering. Last week we talked about how to attach value to the asset. It's crucial to understand, because if you pay too much and you borrow too much, there's nothing anyone can do for you. When's your profit made? When you buy. So we want to make sure that we attach the proper value to the asset. There's a difference between value and price. I'm in this transaction right now. I'm negotiating this transaction. They have this price, but that's not what it's worth. So the price is high, but the value, to me, the value is less than what they're asking for this property. So I'm doing my best to educate them about how I determine value, how I go about it. I'm not trying to trick them or steal the property or take advantage of them. I just don't want to be taken advantage of. So I'm doing my best to educate them as to why I think this is the value. You should sell it to me for this price because of these reasons. I want to be logical, I want to be reasonable, and I want to be objective, but also I want to be clear. And I want to take a stand that I can defend later to my lenders, because the lender's going to want to know, how can you pay that much? Because again, if you pay too much and you borrow too much, you're in trouble. Okay, so now we've done that. Last week we started talking about how do you attach value to the asset. Well, in residential there are two ways. There's the CMA, or comparative market analysis. It's done by comparing active, sold, and expired homes to the subject property. Homes that have sold in a close geographic area that are similar to the subject property at this time. So not a year ago, not 2 years ago, now. The most important comparables of the three, active, expired, and sold, are sold. Because sold properties tell you what buyers are willing to pay for similar properties in this area at this time. The other way to attach value to the asset in residential is appraisal. Appraisals use the comparison approach, like CMA or a comparative market analysis, also called a broker's price opinion. It's a broker's opinion of value, the CMA is. And it's going to give you pretty much a range. They seldom, if ever, will tell you, this is the value for your house. They'll go, well, based on these conditions and based on the area, based on the condition of the house, based on the market out there, based on what other properties are selling for, it's going to be a range of about this to this. And that's how a good real estate broker is going to value property. Appraisals are a little better. They cost a lot of money, well, a lot of money, $500 or $600, but a lot of money to me. But you get three approaches to value. You get the comparison approach like a realtor would do. You also get the income approach, which you don't really need because it's not an income property. And you get the cost approach, which you don't really need because it's not a new house. If you were building a new house, you would need the cost approach. What would it cost to replace the property? Or if the income approach is how much income does the property produce, and what is the capitalization rate of that income? So this is how you, and I'm going to go into that. I don't mean to use jargon or complicated words and confuse people. My job is not to take a simple subject and make it complex. My job is to make a complex subject simple. So I'm doing my best to do that today. So we're going to look at is two things. That's what we covered last week. Values in residential, CMA appraisal. When you get into commercial, you can't do a comparison approach because no two properties are alike. You're very seldom going to find even two office buildings that are similar. So you have to use a different approach to find the value. There's a difference between the value and the return on the investment. So what we're going to cover today is values, how to attach value, and how to measure, how to project and measure the return on your investment. Okay? People say ROI. What's your ROI? What's your ROI? There's a lot of different types of ROI. Which type are you referring to? You talking about a capitalization rate ROI? You talking about an internal rate of return ROI? You talking about a cash on cash return ROI? Which ROI are you referring to? Because ROI means a lot of things. For the uneducated, it only means one thing. So we're going to talk about the distinctions between how to add value, the difference between value and price, how to measure, how to project predict into the future, and how to measure the return on your investment. Very simple, very easy. Please don't say to me, I'm not very good with numbers. You got to get good. You want to invest? You got to get good with numbers. And it's really not that hard. That's just the school system freaked you out about it. Don't let them get under your skin. Just learn the basic fundamental principles. So that's what we're going to go into today. This is an experiment. So I'm going to ask you for your patience up front. Please bear with me, okay? Because I've never done this before. But I'm going to turn this camera over to this other screen. And I'm going to show you, like I promised you last week, I told you that I was going to show you the annual property operating data, or APOD form. And now I'm going to. So we're going to go into approaches to value and how you do this. So this is actually a course that I teach. It's called Know Your ROI Before You Buy. And this is an APOD form. The APOD form is the annual property operating data form. It's the P&L for the property. It's going to tell you the income, the expenses, and the net, just like a P&L. It's going to have 5 categories. Before we get to the P&L, the APOD form, you'll need to fill out some other forms, and you're going to get your 3 different buckets of cash. You're going to have the title company fees, you're going to have lender fees, and you're going to have your down payment. So this is the annual property operating data form that I told you we would go into today. And we're going to pick up where we left off last week. And today we're going to go into cap rates and internal rates of return and what investors are looking for. So we're going to pretend this is a case study, and it was on, this is the address, this is the property right here. It was a duplex, it was about 4,000 feet. This was the purchase price, $105,000. We had a $94,500 loan or debt we put on the property. That's how much we borrowed. And the equity or the down payment we put down was $10,500. So let's go through this scenario. There's some terms that you're going to want to learn. One is right here, GRI, also known as PRI. PRI is potential rental income. So it's gross rental income, let me get this straight, hopefully you can see this, or it's potential rental income. There, is that better? Let me get up close to this. There. How's that? There. Hopefully that's better. So you had your gross rental income of $20,700. Are you going to have vacancies and credit losses? Say yes. Because no matter what the market is, you're going to have vacancies and you're going to have credit losses. So you're going to have people just skip out and they're going to leave typically in the middle of the night and make a mess. But that's no reason not to own it. So I calculate 5% here. And right now the market favors sellers and landlords. So we've got 97, 98, 99, some cases 100% occupancy rates with waiting lists. But I'm going to calculate these vacancies because I'd rather put the number in and it not be that high than put in a low number and have it be high. I'd rather err on the side of caution. So I'm going to estimate that at 5%. Other income would be laundry, parking, vending. This is a little duplex. It's not a home run property. I want to be clear on this, okay? If you sophisticated investors, you're probably yawning and checked out by now. That's okay. I'm talking about a property that any of you watching can go do today. This is a nice, simple little property. You're saying, I can't buy one for $105,000. Like, quit whining about what you can't do and just look at the example and see if you can learn something from it, okay? Don't tell me what's wrong with my APOD or what could be done better. Just do your best to look at it and go, okay, what can I learn from this guy, if anything, today? Okay, just be open-minded. Open up your mind, open up your ears, get your crust out your eyes, brush your hair, and pay attention. So you have this growth. No, I'm sorry, I hear that all the time. You got gross rental income. You subtract your vacancy. Y'all are funny. Vacancy and credit losses. Add in, this plus sign is right here. You would add in any other kind of income you have. And then you have your GOI, which is another acronym you'll need to learn. So that's 19,665. You take your 20,700, subtract that, you get GOI. You're going to have accounting and legal. I don't know what you do, but what I do is I have my attorney look at the title commitment, the survey, and my contract, just to make sure I don't miss anything. There wasn't much in terms of advertising, licensing, and permits because it's a seller's market, it's a landlord's market, and a simple sign out there will suffice. People are driving neighborhoods looking for properties to rent or buy. And a couple well-placed lawn signs for rent, for lease will do the job. We're not paying for their electricity. We're not paying for, there's no elevator in these units. We're not paying for their gas or their oil, ground services. And over here, as you can see to the side, I put my notes so I know what this means. So what this means is lawn service. We want to keep the lawn up because if you have landscaping, it's just going to add value to the property. So it's going to be $50 a month, a trip. $50 a trip. They're not going to cut the lawn every week because it doesn't grow that fast. So we'll cut it twice a month, 2 times a month, and we'll start in April and we'll stop in October. From November to March, the grass is dormant. So the way we got the 700 was $50 a visit, twice a month, April through October. So it should be 100 times 7. Okay? All right, janitorial services. Nope. You got to clean up your own messes, folks. Leasing commissions, sometimes I would put these in there because you'll have to pay. Sometimes you'll want the cooperation of brokers who have tenants. To do that, you'll pay them a commission for leasing the property, which is fine. We love paying commissions and we love paying referral fees for business. However, if we don't have to, we won't. So we didn't on this one. Maintenance, we want to maintain the property. Please keep your properties up. Maintain them. Maintain your body, maintain your relationships, and maintain the property. We're going to have other utilities. No. There's no payroll because there's no manager. Okay? Since there's no manager or payroll, there are no payroll taxes. So that brings us down to pest control. They got to kill their own roaches. You want to get rid of the roaches? Get rid of the food. This did not have a swimming pool, so this is 0. Property insurance on this property was $1,500 right here. No property management fee. Property taxes, as you can see, $25.71. We did some small repairs to the property. We calculated $500 for the year. We are not going to haul off their trash. They got to do that. There was an outdoor faucet, so that was $80 a year. I think they used it to wash cars or something, which is fine. And then there's always going to be some supplies, so I just put $100 on every property and throw it in a bucket to offset some of the supplies. I probably could have, instead I put my cell phone in here, but I didn't. And then there's miscellaneous. You know why there's miscellaneous? Because there's always something. So when you do all that, you get your total operating expenses. Now, how do you make money with real estate? You make it with your mind. So when you have an APOD, versus the industrial age where exchange labor for money, now we're exchanging ideas for money. So we're going to make money on this property the same way we make money in our business. the same way we make money personally. You should have a profit and loss statement for your company. If you're a sole proprietor or independent contractor, I'm going to encourage you to have a financial statement made up for your business activities. Financial statement consists of the P&L, which tells you what you did, the balance sheet, which tells you what you have, and the cash flow statement, which tells you where your money went. The way to make more money when you own property or own a business or have a house is to decrease your expenses and increase your income. That's how you do it. It's nice and simple. Increase this number. Get those rents up. Increase the rents. How can you increase the value of the property so people would pay you more money to live there? And then, how do you get this number down? The gap between the two is your profit. So, if you go back up to the top and you come over here, you go to line 4, which is gross operating income. And then you put the number out here to the side in this blank. If you want to copy this, send me an email and I'll send you a copy. This is your GOI. Then you scroll down and you put your expenses right here. If you take your expenses and subtract them from your income, what you're going to get is your net operating income right here. $12,394. $12,394 is your NOI. Now, if you look at commercial properties, this is the magic number. NOI, you hear it all the time. NOI, NOI. What's your NOI? How much is the property? The NOI is $12,394. Okay, well, how much is the property? The NOI is $12,394. So what you have to do is figure out what cap rate you're willing to pay. Please remember, each investment is unique to each investor. What you might like, I might not like. What I might like, you might not like. So let's just figure out cap rates. We talked about them last week, but we'll do a quick review, and then we'll go on from there. Okay? So if you want to figure the cap rate on this property, all you got to do is whip out your little HP 10B2 right here. If you don't have one of these, I'm going to suggest you go get one. So this is going to tell us, this is not the one I want. Let me get my HP 10B up here so I can show you how to calculate this. Give me just a second. Hang on. Okay, this is the version we want. So what we're going to do, and we got 2 of them. This is the calculation we were doing. So we're going to clear this. We're going to make sure that it says 1 payment per year right here on the screen. So when you get one of these, please go buy one of these. They're only like $30. I think you could even find an app for less. This is one of the best investing tools you're ever going to have, I'm telling you. These things are the coolest. And I don't even know how to operate this whole thing. It's almost like my car, you know. It's got all this technology on it, and I use 10% of it. But I want to show you how to use this to calculate cap rates. So the first thing we want to do is get this screen to say 1 payment per year. They're going to be preset at 12 payments a year. And you can tell because it's going to look like this. And if you're calculating debt service, you'll want it to say 12 payments per year. But we're not. This is an annual property operating data form. Keyword being annual. So we want to get it to 1 payment per year. What we know about this HP10B is when we push this shift button, it talks to the bottom part of these keys, the yellow part, of the orange part, the bottom half. So we press 1, we press shift, we press see where it says PYR, payment per year. We press that. And then we come here to check it. Now it says one payment per year. So we put in 12,394. This is our net operating income. And we divide it by the sales price. We paid $105,000 for the property. And you can do this with any property out there. Your cap rate is 12%. Let's go look at cap rates for a minute. What do cap rates tell you? The capitalization rate is the ratio of net operating income to the property asset value. That's the definition of cap rate. The formula, as we just saw, is we divide NOI by the sales price or value. I don't know why that 4 is there, but pretend it's not. So when we divided 12,394 by 105,000, what we got was this cap rate right here of 12. Now, what are the 4 things cap rates tell us? They'll tell you demand, they tell you the risk, they tell you the value, and they tell you the return if you pay cash. So if you paid cash for this property, your return would be 12%. So let's look at cap rates for a minute. Let's say that you take this same NOI. This is the property. It's got an NOI of 12,394. If you were a 9-cap buyer and you said, you know what, I'm willing to pay as much as 12% is great, but I'm not going to find it in this market. Not in Texas. Are you kidding me? Well, you might if they're really distressed. So yeah, maybe. But the question is, what do they mean and how do they work? So let's take our cap rate friend again. Let's clear this, and let's take our 12,394 and divide it by 0.09. And what do we get? We get 137,711. So if you're a 12-cap buyer, you'll pay $105,000 for the property. If you say, you know what, I would pay 9%, then you would be willing to pay $137,711 for this property. If you go, you know what, I really want to get into the Texas market, I would go 8% on the property. You take your 12,394 divided by 0.08, and what do you get? Well, that person would pay $155,000 for the property. So remember, each property, every investment is unique to each investor. This is the difference between value and price. You've got to determine the value. The seller will determine the value. You've got to determine the price that you want to pay. What is the value of the property to you? So let's say you said, you know what? I would go as high as 7 if I found the right property, and you have an investor, or you yourself are an investor, and you'd be willing to do that. Then you come back to your old HP 10B buddy over here, you put in your 12,394, you divide it by 0.07, and you get 177. Let's say the property is being advertised as 12,394. It's a 6-cap property. You go, what? What does that mean? 12,394, 6-cap property. Why don't you just tell me the price? Because they don't do that. So if you're willing to pay a 6% cap rate, then you put in 12,394, and you divide it by 0.06. And you'd be willing to pay 206, 566. Then at 5, it's 247. So what are you noticing about cap rates? The lower the cap rate, the higher the sales price, or what they're considering to be the value. The sales price is what you're going to pay. The higher the cap rates, the lower the sales price. So what's your formula? Well, the formula is simple. You can buy on a 9 and sell on a 7. Buy on an 8 right here. Buy on an 8, sell on a 6. As long as there's a gap. Your profit's made when you buy. I don't know who's paying 5%. Well, there's a lot of people out there. Because right now, multifamily, office buildings, some commercial, office buildings not anymore because a lot of them are vacant. But the apartment sector, the multifamily, they can 5% cap rates. Some 4.5%. Some are 4%. So what some people would be willing to pay, look, you know what? I'm not going to pay I'm not doing it. I'll pay 138. That's my number. Somebody else will go, you know what? I think we're in for a long haul. I'll do 206. I got to put my money into something. So it's a total arbitrary number. There's no rule of thumb. This is how you manage and measure cap rates. Hope that helps. Let's go back to our next calculation in terms of return on investment. This is cash flow. So I want to talk about cash flow, and then we'll talk about our cash on cash return. So if you have $12,394 of net operating income, in order to get our cash flow number, we've got to separate the last expense on the property. We've got all our expenses here, but this doesn't include debt. NOI, this number here, has nothing to do with debt service. Nothing. NOI has nothing to do with debt. Debt has nothing to do with NOI. Debt does not affect the value of the property. It affects your cash flow, because if you have debt, then you have to make a mortgage payment or a debt payment monthly. If you have no debt, there's no debt payment. But whether there's debt or no debt doesn't matter. The expenses of the property are expenses of the property, and debt doesn't matter. It has no effect whatsoever on the value of the property. It does affect your cash flow, because if you have no debt, you got more cash flow. And the more debt you have, the less cash flow you have. Right? Common sense. So what we're going to do is we're going to say, I'm going to scroll up to the top right here. We're going to take our $94,500 mortgage. We're going to finance it for 30 years. At the time, it was a high loan. It's like 8%. Anyway, it came out to $8,719 a year, principal and interest. If you'll look, your property taxes are right here, and your insurance is right here. So your TI of your PITI, property, insurance, principal, insurance, principal, interest, taxes, and insurance. Your taxes and insurance are already in your pro forma. This is P&I, principal and interest, debt service. Subtract that from your NOI and you get $3,675 a year. That's your before tax cash flow. That's ordinary income. If you have no way to offset that, and you could offset it, this is not an accounting class, so I'm not going to go into all that right now, but it's possible to not have to pay tax on this. If you have losses on other properties, you could put the losses against the gains and come up with less or no tax. But that's another class for another day. Right now, we have $3,675 in cash flow. Let's say you're in the 34% tax bracket. You're going to pay $1,249 to the United States government, the IRS, the Treasury, in taxes. So your after-tax cash flow is $2,400 a year. So this property is going to give you a cash flow of about $200 a month. Again, it's not a home run. It's just a nice, simple, solid little property that anyone who's listening or watching this, any of you can go do this. Anybody. All you got to do is run your calculations. So let's go look at cash flow now. Another way, we'll come back to this part. Another way that we can look at return, so it is our cash flow. So here's cash on cash. Here's the definition. The rate of return. It calculates the cash earned on the cash in a property. Here it is. It's the ratio. The cash flow that comes out of the property based on the cash compared to the cash flow that went into the property, expressed as a percentage. So how much was the before tax cash on cash? As we saw up above, it was $36.75. It cost us $4,726 to acquire this property. That's all. We put $4,700 down. That was the total cash investment to acquire this property. So what's our cash on cash return? It's 78%. We get 78% of our cash back. We put this much into the property, $47.26, and at the end of the first 12-month period, the property gave us this much back. So we got 78% of our cash back in the first 12 months. How's it calculated? You divide your cash flow by the initial investment. So the cash flow was $36.75. The initial investment was $47.26, and that's how you get it. So we'll bring our little friend back out here. And we'll clear this out. And we'll say 36.57 divided by the amount we put in, which was $47.26, and we get 0.77, 0.78%. That's how you calculate your before tax cash on cash. What does cash on cash tell us? It tells us when your money comes back. So there's two things that most investors want to know. One is, what is the return on my investment, and what is the return of my investment? And the first thing I want to know is, when do I get my money back? So what cash on cash tells you is when you get your money back. How much did I put into the investment, and when do I get it back? That's the return of my investment. Okay? I want to know two things. Return of, return on. When does my money come back? That's cash on cash. And what is return on my investment? How much did I make by investing that money? That's return on. Now, what are you noticing about cash on cash? Higher is better. So now we have cap rates. Now we have cash on cash. Nice and simple. How much went in? How much came out? Take how much came out, divided by how much went in, that's how much we get. After tax cash flow, the property is producing $24.25 a year after taxes. We put $4,700 in to acquire it. We got half our money back in year one. What this tells me, in 2 years, I get my money back. Any questions? Okay, great. Next you have gross rent multiplier. These aren't used very often, but this is how they're used. It's the ratio of the price of the real estate investment. I'm reading this right here. to its annual rent. The ratio of the real estate investment to its annual rent. Okay? So it's the number of years the property would take to pay for itself in gross revenue. Number of years it would take to pay for the property in gross rents. So how do we calculate it? To calculate GRM, you divide the selling price, or the value, whichever one you have, by the property's rents. So that's how you do it. Here's the formula. Sales price divided by gross rents. Well, what was our sales price in our example above? It was $105,000, right? Right. What were our gross rents? $20,700. There's your GRM, 5.07. Well, what does that mean, Wayne? Is that a good GRM? Is that a bad GRM? Is there a rule of thumb for GRM? Yes. Great question. Here's the answer. How do we use GRM to calculate the value of a property? Well, to calculate the value using GRM, simply multiply the gross rents by the GRM. So let's say, and here's this formula, GRM times gross rents. Let's say all you had was the GRM and the gross rents. You're like, okay, what is the value of this property? I've got an NOI. I've got a cap of $12,394. I've got a cap rate of 12. That means it's worth about 105. Let's try GRM. Okay, my GRM is 5.07. I multiply that times the rents. That's also 105. The question is, where does this number come from? I mean, what does GRM mean, and where do we get that number? Great question. We get the number from market research. So what you do is you call the local brokers in your area. You go, what are GRMs doing in Austin on multifamily? What are the GRMs for office? What are the GRMs for strip centers? What are GRMs for industrial? And they'll tell you, because there's a market GRM. Just like cap rates are 4 to 5, we can know what GRMs are. It's not used very often. I just want to cover it so I can tell you I covered it. If someone goes, yeah, what's a GRM? You can go, oh, no problem, I know that. So let's say the property had a GRM of 6. What's the value? Well, you take 6. How do you calculate GRM? You take 6 times 20,700. Your value is 124.2. If your GRM is 7, you multiply 7 times 20,000. Oops. 0. 20,700. And what do you get? 145. So as you're noticing here, the higher the GRM, the higher the value of the property. So what do we want when we're buying? A low GRM. What do we want when we're selling? A high GRM. It doesn't mean anything by itself, but when you look at everything, when you look at the cap rate, the cash on cash return, the GRM, you look at all of them together, you start to see a pattern. And if your NOI, if your cap rates are high and your GRMs are low, you're looking at a property that's priced below market. Now, it's probably distressed, so you're going to have to do some work on it, but hey, that's how you make money. So what are we noticing? The higher the GRM, the higher the price or value. So what we want to do, again, we want to buy on a 5 and sell on a 7. Buy on a 7, sell on a 9. Well, that's how GRMs affect value. Our next calculation is internal rate of return. Now this is the return on the investment, the time the money is in the investment. How do we measure cash flows over time? So in year 1, you got this cash on cash return, right? You put money into the property and money came back out. But in year 2, you don't put that money in. The money's already in there. Now, if you're calculating maybe a 5-year hold, you're going to acquire this property, hold it for 5 years, and then sell it. Well, if you do your cash on cash return, that's your first year return, but you didn't put all that cash in. You don't have lender fees and title fees and prepaid items and inspections and all that in year 2. But that cash is still sitting in there. So how do you measure the return on that money over the 5-year investment period? Well, that would be the internal rate of return. And the definition of internal rate of return, or IRR, now this is an ROI calculation. This is the return on the investment during the time the money is in the investment. That's the definition of IRR. Great calculation. This thing is really, that's one of the most common used in commercial. Cap rates and IRRs are the 2 most common examples. So, how do you measure cash flows over time? IRR. So as I said, example 2, in year 2, you don't have any, in year 2, there aren't any acquisition costs. So it's possible rents decline, or you have to feed the property. All things could be happening. So I want to calculate these cash flows. We're going to project them over time. This is the formula, and this is weird and crazy. So this is how you calculate IRR. Okay. So the first thing we're going to do is we're going to clear this. Then we're going to take our cash flows. The first thing we're going to do is we're going to put in our initial investment. So we're going to clear all to verify, and we're going to put in $4,726. That is what it costs to acquire this property. It's a minus number. It's going out of our pocket. So it's minus, and we're going to hit this right here, cash flow. That's cash flow year 0. I hope you saw that. Then we're going to enter the annual cash flows, which are $36.75. So we put 3675. Now watch when I push this screen. You're going to see it flash 1 and then go back to the number. Cash flow for year 1, there's the number. Then we're going to do it again. Year 2, we're going to get $36.75 in cash flow. And we're going to enter that year 2 cash flow, $36.75. Then we're going to go $36.75 again. We're going to push cash flow because that came in. It's a positive number. And it says right there, cash flow year 3, $36.75. Then we have 3675. This is, cash flow year 4, $36.75. These are even cash flows, which is going to be rare because they're going to vary, but this is just an example to calculate them. Now, in year 5, we're going to have this future value. We're going to sell the property, plus we're going to have the cash flow. So let's assume that the value of the property is $135,000. It increases from the $105,000 we paid for it to $135,000 over 5 years. So to get our last cash flow number, we've got to add the future value, the sales or disposition price, to the cash flow. So if you add $135,000 to $3,675, you're going to get $138,675. So we put in the sales price plus the cash flow for our 5th entry in year 5. We're going to sell it. When we sell it, we're going to get sales proceeds, but we're also going to have the cash flow for that year. So that's going to be 138,675. And we're going to enter that. Now, all our numbers are in there. We're now going to calculate our IRR number, which as you can see, internal rate of return is right there. but we've got to get it to talk to that bottom half of that number. So we're going to press this shift. We're going to press IRR, and it's going to calculate 132.4%. That's our internal rate of return. This is extraordinary. 18 to 22, 24, great IRRs. This property's got a 12% cap rate, a 5% GRM, and 132% IRR. It's not a home run. No one's getting rich. We're not buying a jet with this property. We're not buying a mansion. But you know what we've got? We've got a nice little solid single that's going to pay us for years. If we keep paying that mortgage down and just incrementally raising those rents a little bit over time, then pretty soon your debt is going to go down, your income is going to go up, the value is going to go up, the cash flow is going to go up, and you're going to have a nice little property that's going to pay you for years. Now let's assume that your property cash flows, let's assume that you go in here and you have different cash flows. So here's your cash flow for this. And my question is, do rents remain steady? And the answer is probably not. So people are going to have late fees you might collect and get a little extra. You may have a tenant that leaves. You might have a little minus, a little less. But they probably won't be the same every month for 5 years. And they won't be the same annually for 5 years. I think in our leases, we should put a bump in there. I think it should be at least 3% annual bumps. So if you put a bump in there, and we'll do these calculations real quick and we'll wrap up. So we start with our 4,726 as our minus cash flow year 0. And then we have 3675 cash flow year 1. And then look, it goes up 3%. So it's 3785 year 2. And then look at this. This is cool. It just keeps going up. 3899 cash flow year 3. We got 4,000. This is awesome. How cool is this? The property value keeps going up. Cash flow year 4, and then cash flow year 5. The cash flow goes to 4136. We've got this disposition or sales price of 135. If you put those together, you get 139. 136. Add that. All year, 5 years are in there. Click our shift, our IRR button. Not a huge difference, but these little things like this add up. So now this is going to affect your NOI, which is going to affect your value, because value is based on income. So what do we know now? We know that we used $4,726 of our own money to acquire a property for $105,000. We think we'll sell in 5 years for $135,000. Our projections are that we've got a before tax cash on cash of about 78%. We've got an after tax cash on cash of 51%. Now we know in 2 years we're going to probably get our cash back. We know our cap rate's 12 at acquisition. We know our cap rate is 5 when we buy it, when we acquire it. And we know our projected IRR is going to be 132%. Well, what do we also know? What I know is I bought this property and I did sell it. We sold it 5 years later for $135,000. Our closing costs were about 5% or $67.50. We paid off about, we didn't dent the principal much in 5 years. Our net was about $33,250, and this is what our gain was. And I bought a wedding with it. For sure. Our daughter decided to get married, so we sold this to pay for a wedding. Properties are cool to have. So what do we know? What do we learn? How can we apply this? What we know is when we're buying, we want to buy a problem property. You're buying a 12 cap property, anything north of 6 or 7 in today's market, that thing's going to have problems. And what do we want? We want a problem property. Problem property, problem seller, opportunity for us. When we're selling, we want to sell a problem-free property. When we're buying, higher cash on cash is better. When we're selling, higher is better. When we're buying, higher cap rate is better. If we're selling, lower is better. When we're buying a GRM, lower is better. And when we're selling, higher is better. And IRRs, they're just always better. So, that's it. I hope that helps. So that's what we teach, how to get a license, how to use it. This is the learn to use it part. So this is why I say, I know the camera's kind of crooked because they're uneven surfaces I'm working with. So thank you for your patience and thank you for bearing with me. I hope this was helpful. I hope this experiment worked because I wasn't sure if I was going to be able to show you that screen. So thank you for your patience. I hope this was valuable and I hope this was helpful. Any of you watching can do this. So if you have any questions anytime, just email me, info@buildmyrebusiness.com. info@buildmyrebusiness.com. And you can always go to our site, which is obviously buildmyrebusiness.com. So when I talk about insider trading being legal, this is what I mean, because you now have information that most of the public doesn't have. And when you go into MLS, you can find these properties. There are distressed properties every day in the multiple listing service. Every day. Okay? Okay. So I'll end the way I started. Thank you for your time. I hope you found it well spent. I hope you found something you can use today. And if you'll email me about what you'd like to learn next week, then we'll cover it. What would you like to know? What did I not cover, or what did I not cover well that you would like for me to cover again? If you'll tell me, we'll cover it. If there's any articles I can send you, or you want these pro formas, if there's anything we can do for you, let us know. We're here to educate you and tell you what we learned. I'm not an expert. I don't have a degree in accounting or finance. I just got years and years and years and decades of experience doing transactions, doing investment properties, buying, selling, negotiating, and having a grand old time making a bunch of money. So it's fun. Let me know if we can be of service. I'm going to sign off. Thank you for your time, and I'll see you next week. Email me and let me know what you want to cover. info@buildmyrebusiness. Enjoy your day. Remember, you were born a genius and meant to be an incredible success. Let's go out and make it a better world. Thank you.